Hi, I'm Julia from Capital Markets Group, and today I am going to speak about equity and mezz financing. Equity and mezzanine lending are two types of financing options used in commercial real estate projects, particularly for larger transactions where traditional debt financing may not fully cover the capital needs. Here's an overview of each. Equity financing involves raising capital by selling ownership stakes or shares in a commercial real estate project to investors or partners. Investors provide funds in exchange for an ownership interest in the property, typically in the form of equity or partnership interests. Equity investors may include individuals, institutional investors, private equity firms, or real estate investment trusts, REITs. Equity financing can be used for various purposes in commercial real estate, including property acquisitions, development projects, recapitalizations, or restructuring existing ownership. Qualifying for equity financing often requires demonstrating the potential for strong returns on investment, presenting a well-defined business plan or investment strategy, and attracting investors interested in the project's objectives and risk profile. Investors may conduct due diligence on the property, market, and management team to assess the investment's viability and potential risks. Mezzanine financing is a hybrid form of debt and equity financing that sits between senior debt and equity in the capital stack. Mezzanine lenders provide subordinated debt, which ranks below senior debt in terms of repayment priority, but above equity in the event of default or liquidation. Mezzanine financing typically carries higher interest rates and may include additional fees or equity warrants to compensate for the increased risk. Mezzanine financing is often used to bridge the gap between the amount of senior debt available and the total capital required for a commercial real estate project. Qualifying for mezzanine financing may involve meeting certain leverage and debt service coverage ratios, providing collateral or personal guarantees, and demonstrating the ability to generate sufficient cash flow to repay the debt. Mezzanine lenders may also assess the property's value, market conditions, and borrower's creditworthiness to determine the loan terms and pricing. In summary, equity financing involves selling ownership interests in a commercial real estate project to investors, while mezzanine financing provides subordinated debt with higher risk and return characteristics. Qualifying for these financing options typically requires presenting a compelling investment opportunity, demonstrating the ability to generate returns, and meeting the lender's criteria for risk and creditworthiness. Working with experienced advisors and lenders can help navigate the complexities of equity and mezzanine financing in commercial real estate. If you would like to learn more about equity or mezz financing, go to www.capmarkgroup.com commercial, financing commercial, real estate, financing, and fill out the form.